Hello and welcome to David Bahnsen's Capital Record, brought to you by National Review. We are going to do a quick dive into a topic that we've covered over the years here at Capital Record with various guests quite a bit. I've had in the past Jerry Boyer, who is the head principal at Boyer Research, a consultant that works closely with me and my firm at the Bahnsen Group, is a economist, a fellow Christian friend, someone I do a lot of both business and have a great personal relationship with, but he has been integral in partnership in terms of our efforts of what we call shareholder engagement. And others that have been on the podcast similar in this vein. We've had past representatives from the State Financial Officers Foundation, Jeremy Tedesco, Senior Vice President at Alliance Defending Freedom, involved in a lot of legal efforts. So there's sort of a web of people around the country that have taken on the issue of shareholder engagement. And I, being one of them, as an investor, as a investment manager, have a lot of skin in the game on this issue. But there's been a couple of things that have happened in the news in the last week that I think brought this topic back to the forefront that I wanted to hit on real quickly in Capital Record this morning. There's a few schools of thought and how various people think we ought to engage as investors with corporate America. One of the more popular approaches has been boycott, to say XYZ company is doing something wrong, is doing something dumb, is spreading all kinds of DEI stuff or LGBT radicalism or ESG, critical theory, wokeism. All of these things are somewhat connected. All of them are a little bit different, but overlap, but you get the idea. And that stuff all existed, and there were just silly things corporate America or parts of corporate America could have done for many years, but it really hit an accelerated level, obviously, in the so-called George Floyd, COVID, peak insanity moments of 2020 and 2021. And there was a belief that big tech issues, the bank issues, and where the culture war issues, that this was no longer the Nike battle of, let's call it now, maybe 10 to 12 years ago, of Colin Kaepernick and ads kind of poking at the American flag and insinuating a rather aggressive approach on some of the racial culture issues. But rather, it just became a kind of systemic thing of really capitulating to radical environmentalists and definitely radical culture warriors. And there were high-profile things that took place, like the insanity of an Anheuser-Busch ad trying to push for that ever so important market segment of transgender beer buyers, and other virtue signaling things that would take place across corporate America. And so many in kind of strategy number one appeal to a boycott orientation. Now, the good thing about a boycott solution is when it's consumer oriented and not equity oriented, every now and then it has a chance of working. The Anheuser-Busch situation, there's arguments to be made that Target consumer oriented boycotts were effective. Others, not so much, because for the very reason that, as we saw with Nike and Colin Kaepernick, it's very possible that those things could be marginally beneficial to their target market, where with Anheuser-Busch, it was just clearly a very different story. When you're alienating more customers net than you're capitulating to or appealing to, then the not only the math, but just the kind of demographic reality comes to the forefront. Boycott with equity investment is different because you have very little chance of making a difference, no matter how organized the effort is. The large cap nature of most of these companies is such that index owners have a disproportionate ownership, as well as institutional investors between pensions, endowments, foundations, and so forth, that are often going to be more aligned with the wrong side of the culture war. So an individual investor saying, that's it, I'm not going to own it, isn't going to move the needle, isn't going to hurt anybody, isn't taking any primary capital out of their cap table. And so consumer boycotts and equity boycotts are different. Then another approach has been basically activism to say, no, we're going to go own a company we don't really necessarily care for, but by owning it, gives us a chance to go try to, poke the bear a little, become activist. Sierra Club has done this environmentally for a while. A bunch of environmentalists famously did this with Exxon a few years ago for the purpose of what ended up being successful in getting a couple people on the board. Whether it is a left-wing or right-wing group is immaterial. The strategy is immaterial to your investment objective to take an equity position for the purpose of raising some hell. And this is a different approach versus boycott versus strategy number 3, which happens to be the one that I'm deeply committed to. Both is a matter of principle and a matter of pragmatic. And that is shareholder engagement that is authentic shareholder engagement. The authenticity can be applied, this adjective of authentic, to both the role of shareholder and the engagement. And what I mean by that is that one's ownership of the company is real. It is driven by belief in what the company does, at the business model, the investment merit. It is not ownership taken for the purpose of activism. It is rather activism taken for the purpose of enhancing the ownership experience. And so my belief is that there is a categorical difference between owning something so you can be an activist and being an activist because you own something. And then the authenticity applies to the engagement itself. Are you interested in tweeting a headline? Are you interested in getting a headline, in clickbait, in trying to shine a light on some bad behavior, whatever the case may be? Or do you believe that the company itself will be benefited from what your end run is? So in the sense of Exxon, activists that say we want to get you out of oil and gas obviously don't think that's best for Exxon. Now, they may think it's best for the planet, and they could be right or wrong. I happen to believe they're not just wrong, but fatally, catastrophically wrong. But there's not really a hiding the ball, that they're basically saying to hell with the company, but we have a social agenda. When authentic shareholder engagement is administered, you have to genuinely believe it's best for the company to not alienate customers like Anheuser-Busch. It's best for the company to not take a stance on a toxic cultural political issue that is going to hurt their engagement with vendors or with employees or with customers or whatever the stakeholder in the business may be. So that is my view of those 3 main options. There's others, by the way, on the table, but they have a kind of smaller piece of the pie, if you will, in terms of strategies of shareholder engagement. Strategy number 3 is what I believe is right, honest, authentic, the most opportunistic, and ultimately the most pragmatically beneficial. And over the last week, a couple of things happened. One, in a video presentation to Davos that now President Trump made, he made comments about some of the debanking efforts that had debanking, situations that had taken place. His comments mostly pointed at CEO Brian Moynihan at Bank of America. It regenerated a little attention on what was one of the most famous debanking incidents and sort of developments that took place with JP Morgan. Now, JP Morgan is a company that I have owned at the Bahnsen Group on behalf of clients and obviously myself personally for now, as we get close to March of 2025, for 16 years. We took our position in March of 2009. We took it because we believed it was by far the bank best positioned post-financial crisis. It was the bank that by far had picked up the most new assets and revenue streams at either a free or very low price out of the financial crisis. In other words, they had been playing offense while almost every other big bank was necessarily playing defense and in fact fighting for their survival. And that as the Fed and other post-TARP capital controls lifted, that JP Morgan would prove to be the best dividend grower, which dividend growth is the investment strategy we utilize at my firm that I've been married to professionally for many years. We happen to have been right on this call. JP Morgan's been a just wildly profitable investment for us, not counting dividend reinvestment. It's up to very nearly 1,000% since we first bought it at this time. However, there was a high-profile incident a number of years ago where it appeared that Sam Brownback, the former senator and former governor of the great state of Kansas, involved with some conservative political and religious liberty nonprofits, had his nonprofit organization debanked. I happen to believe that there was indeed a debanking effort. I happen to also believe it did not come from Park Avenue and where the C-suite of JP Morgan sits, and that it was some woke, rogue middle manager, bank manager, what have you. The way JP Morgan handled it after the fact was terrible. Different stories, different excuses, different things said and done. And ultimately, I, through my consultants with Boyer Research, filed a resolution demanding some change, demanding a harder look at what their debanking policies were. And the aftermath of that incident was unbelievably unambiguous commitments from the firm that no debanking will happen on political or religious grounds, and reinforcing the data around hundreds of thousands of conservative and religious organizations that do have accounts with JP Morgan. None of that takes away from what could potentially have happened. Now, I will say to listeners right now that are frustrated saying, oh, come on, we know that they debanked and this happened, and I've heard that this happened. I myself solicited others who might have experienced something similar and got not 100, but it was over 50 responses. And we and our team investigated each and every one of them. And it was something in the range of 97% that they were not being debanked. They were refusing to provide very standard paperwork. They had not followed up with appropriate, account opening procedures, and then claimed to be debanked. And the high volume as a percentage of false accusation caused me to believe that things had moved in the right direction. But nevertheless, it didn't really matter at this point on a go-forward basis, because the CEO of JP Morgan, Jamie Dimon, did not say, oh, well, this did happen because we really felt strongly that we had to take a stance against this or that issue, or anyone who was involved with Jan 6, or anyone that had voted for Trump, or anyone who did this or that. He just said it didn't happen. It's not going to happen. He didn't leave himself wiggle room in the future. And we had extensive conversations with the investor relations team at JP Morgan that convinced us there was sincerity. And then ultimately the very high profile nature of who their CEO is, Jamie Dimon, and the approach he took going forward convinced us they were on the right track with it. The next year, they had bought a payment processing company at JP Morgan called WePay. There was a lot of really problematic language in their vendor agreement about who they could and couldn't allow to process payments in their system. We formed a shareholder resolution to go after that issue. And they said, well, you put your shareholder resolution to bed if we take all that language out. And they did. Okay. This was all a byproduct of constructive conversations with me and my team, with our consultants, our lawyers, and JP Morgan proved to be a good faith actor on it. Are there still things in their 10Qs and 10Ks that we don't like? Of course. Is there still going to be a bunch of woke things that go on there and whatnot? Of course. Is the entire cause won? No. Have they moved the needle substantially in the right direction? And all as a byproduct of constructive and authentic engagement? Yes. Now, more recently, what has come back in the news is PepsiCo, very large company. Many don't care for their soda. I will tell you that they are a snack company, first and foremost. They own the Frito-Lay portfolio of brands. They own the Quaker Oats portfolio of brands. They own Gatorade. So there's a lot of sports drink, bottled water, snack brands, and then, of course, the soda pop of Pepsi, all within their portfolio. So it's a massive company, but they were a part of a group that thankfully seems to have been left for dead, the Global Alliance for Responsible Media. So I generated a shareholder resolution just asking them to question their involvement in a group that we believed was participating in discriminatory ad buying and filtering out various organizations for their political or religious views in the way that they processed advertising. Pepsi not only came back, GARM, this group they're not a part of, but the group itself is basically no longer in existence. But what they did is they said, if you will withdraw your ballot, we will specify our language publicly that we will not tolerate selection around political or religious filters. Categorical policy change within the company that they're going out on a limb to do after a byproduct of multiple conversations with our consultants at Boyer Research. So you have a permission structure to other major companies in corporate America that we don't have to go brag about how we are filtering based on pro-lifers, based on traditional moral views, based on a political stance, that in fact, we're not going to discriminate on this. This makes it a better company. You can sell more soda and snacks when you're not discriminating against people. But it also is, I think, a light and a signal to other companies that there's not going to be pushback for you doing so. So it emboldens others. So there's leverage in the decision Pepsi's made. And this all came about through our legal rights bestowed upon all shareholders. I mean, subject to certain criteria, how long you've owned shares and owning a certain minimum. It's not a high minimum. We happen to own a lot of it. I own a significant amount personally, but then I own a lot on behalf of clients. And I so have the clout, and obviously consultants and lawyers on payroll that are able to go, play a role in partnering with this. The great work that Jerry and his team at Boyer Research have done is vital. I don't want to take any credit for this personally. I'm an actor in all of it, no doubt, but this is not coming at a cost to me other than some time and money. This isn't going to hurt my reputation. I own my own business. I'm not going to fire myself. But a lot of people are going out on a limb, but what they're doing here is not risking making enemies with strangers. I promise you, Jerry doesn't care. I don't care. Others involved in this don't care. What it is opportunity to formulate authentic conversations with people that can understand where you're coming from, how you believe it is best for the business, the fiduciary duty the company has to their equity owners, and where we are not saying you have this toxic political stance or moral stance on an issue. We want you to take our toxic political stance. What we're saying is go sell more soda and snacks and knock it off. Quit discriminating on advertising. Be a bigger and better company. It's authentic shareholder engagement. We believe it's the right approach, and it is actually working. And we're not asking new right authoritarian tactics of governmental interference to help us. We're not saying the sword is in the left's hand and they're beating up conservatives with it, which it has been and they were doing. And we want to take that sword and we want to beat them up using the power of the state in the same way they were, but on our side. We're not doing that. First of all, because it's wrong. Second of all, because it's only a matter of time till the sword slips out of our hand and back to theirs. Those aren't long-standing solutions and they're not principle-based. What we're doing is principle-based activity driven towards the authenticity of ownership and the constructive nature of shareholder engagement that leads to better results for the owners of a business. It's market-oriented combined with utilizing the tools available to us in the rule of law. It's a classically conservative strategy geared towards the common good and the profit motive, a free and virtuous society. Thank you for listening to David Bahnsen's Capital Record, brought to you by National Review. Shoot questions to us anytime. questions@thebahnsengroup.com. Please share this podcast liberally with your friends who would benefit from these short tidbits every Tuesday and Thursday, encountering real life issues from the headlines to make a better defense of free enterprise available. And we appreciate you listening to David Bahnsen's Capital Record.